Okay, great. Looks like our some of our stragglers have jumped on board. I'm going to be your moderator today. My name is Matt Posner, and I'm the head of market strategy for Neighborly. We're very excited about the turnout that we're seeing and interest in this very relevant topic, tax reform. And just from a broader arc, Neighborly intends to continue to help educate and innovate the public infrastructure community to help better understand market conditions, policy, and credit implications that impact us all, whether we're selling municipal securities, trading municipal securities, or investing in them. For today's discussion, we're hitting probably the most important topic that this industry has seen in a long time, and that's tax reform. It appears that we're going to see comprehensive tax reform for the first time in 30 years. And quite frankly, it surprised many of us with how much it really is going to impact the municipal securities market. While we focus so much on the importance of the tax exemption, there are other areas that appear to be going to be carved out of the future of our market and how public infrastructure is financed, whether it's private activity bonds, advanced refundings, the state and local tax deduction, or corporate tax reform. These all have large implications for our market. So what we've done is we have two speakers we're very excited to have participate in this discussion. We have Rob Wagner, who's a managing director with American Continental Group Analytics, who is based in Washington. And Rob's going to kind of walk us through the bill itself and then also political realities, what he thinks is could actually transpire quite frankly, over the next 2 weeks. And next we have George Friedlander, who is going to give us the sort of the political and more like financial implications for our market. So just briefly, Rob joined ACG in January of 2016. He covers a range of issues, including financial services, housing, and congressional and regulatory policy actions affecting investment strategy in various U.S. industry sectors. Prior to ACG, Rob served as Continental to Representative Richard Hanna of New York. George Friedlander joined Court Street Group, an independent research policy organization, a year ago, and prior to that, he spent 40 years at Citigroup doing a plethora of things. And quite frankly, George, I don't think you need much introduction because you've been engaged in our marketplace for such a long time. So with that, one logistical issue. We encourage people to ask questions. And if you're not familiar with Zoom, which is the technology we're using for this, if you bring your cursor to the bottom portion of your screen, it will offer you the ability to ask a question. There's a Q&A button. And if you want to ask a question, and again, it's highly encouraged, we want to have this be a two-way flow. You can click on that button and you can write out your question and you will remain anonymous. So other folks won't know who you are, but unless you want to be, and we'll do that. And only myself as the moderator will be able to see it. So with that, again, thank you so much for joining us. We're very excited. And Rob, I'll let you take it away.
Thanks, Matt, for the introduction. So as we know, a week ago today, the Senate passed their version of comprehensive tax reform. The House had passed their bill the week before Thanksgiving. So now the two chambers have to go to what's called a conference to resolve the differences. And there's several key kind of policy differences that need to be worked out between both the House and Senate. But before we get there, there's also some more political challenges. The first is funding the government. So yesterday, both the House and Senate passed a 2-week funding, which will extend till December 22nd. They're working on a long-term fix with both House and Senate, Democrat leadership, and President Trump. There's a couple obstacles to that. One thing that could derail the Senate bill is that Senator Susan Collins of Maine indicated that her vote hinges on Alexander Murray, which is a bill that extends funding for the insurance subsidies under the Affordable Care Act. to also be passed along with the longer-term government funding before the conference tax bill. It's now possible that the final tax vote will occur before there's long-term funding in place. House leaders indicated today that they will not vote on the bill until the week of the 18th, so not next week, but the following week. I wouldn't be surprised to see a bill released towards the end of next week, but there'll be no final vote until the week of the 18th. So if Senator Collins doesn't have that Affordable Care Act legislation in place, then it's very possible that Republicans would have no margin for error. Senator Corker, who voted as a lone no Republican vote last week, is not expected to change his vote, and Senator Collins would then be the second no Republican vote, and Vice President Pence could break a tie, but they couldn't lose any more after that. The other potential obstacle is the Alabama Senate election, which is next Tuesday. The Senate hopes to pass a final bill before that, or at least have a final bill before that senator is seated, which could be until about the 22nd is the latest, they're saying. That's because Roy Moore is kind of a volatile Republican. I'm sure you've seen the headlines with kind of his controversies. And there's also a Democrat running, which winning in Alabama would be pretty rare. So they're hoping to avoid any kind of issues there. Moving on to the next slide, there's several policy differences between the House and Senate bills. The first is state and local taxes. So while that provision is now identical, thanks to Senator Collins' amendment that included allowing a cap for state and local property taxes. California Republicans are adamant that they need to also allow state and local income taxes along with property taxes. So that will be resolved, but they'll still probably be the same $10,000 cap. There's also several international provisions. They differ in how they work, but the end goal is the same. It's basically base erosion provisions that prevent companies from moving operations overseas. They also differ in pass-through treatment. That's partnerships, S-corps, sole proprietorships, LLCs. So what the House does is they have a 25% business rate, where the Senate bill allows a 23% deduction off 50% of your earnings to treat as pass-through income. They'll likely accept the Senate version there. The other key difference got thrown in the mix very late on Friday was bringing back the corporate alternative minimum tax. That is likely to get thrown back out in the final bill. That's kind of a last-minute revenue grab by the Senate there. Another key difference is that both bills allow for full expensing of capital expenditures. The difference is that the House does this on a EBIT basis, the Senate does it on an EBIT basis, where the House is EBITDA. So that's kind of a key accounting difference there. They'll have to be worked out. They also differ in the number of individual brackets. The House has 7. The House has 5, where the Senate has 7. And also the Senate leaves in place the current mortgage interest deduction, which is capped at $1 million, where the House caps it at $500,000. I would be surprised to see them kind of split the baby there and end up at 75 or $750,000. If we go to the next slide, there's some key differences there's some key impacts on the municipal bond market, which George will talk about more. But basically, the House bill repeals the deduction for state. Sorry, I mentioned this before, but the Senate bill caps the property taxes in the final version, where the House bill did the same thing in their final bill. Excuse me, but like I said earlier, the California Republicans really want, and their vote hinges on getting state and local income taxes. They also included in this. Going on the next slide, we have some implications for the municipal bond market.
Hey, Rob, quick question as we're kind of going through this. How does funding the government, as they push it off 2 weeks, what are the implications for getting tax reform completed?
Yeah, sorry about that. I lost my connection for a second.
No, that's fine. I'm getting a couple questions in already. about, before we get into implications, direct implications for the municipal market. What are your thoughts on, from what I understand, you're better at this than I am. They passed sort of like a temporary amendment to fund the government for 2 more weeks. Does that have implications for comprehensive tax reform before the end of the year?
Yeah, absolutely. What they did last night is both the House and Senate passed a 2-week extension, which will last until December 22nd. As I mentioned, there's some issues with Senator Collins and legislation she wants included before a final tax bill is passed. So they need to keep her on board and at least give her assurances that that legislation will eventually be passed. However, there's a lot of opposition to it in the House. So there'll certainly be some obstacles there.
Is there a situation in which Collins doesn't vote, Corker doesn't vote, and that you don't see tax reform coming through?
So if those two are the only ones that would vote no, then Vice President Pence would break a tie in the Senate. In that case, it would pass, but they'd like to avoid that because there's obviously no margin for error after that. So if you have another policy change that kind of takes off a senator, then you're looking at more losses, and at that point, then a bill would not pass.
Yeah, it's really fascinating. Sorry, we were getting a lot of questions in, so I just wanted to pull that out. I believe you're on alternative minimum tax, but I think maybe you want to go back 2 screens just about sort of the how the legislation directly impacts municipal securities.
Yeah, it should be right off the state and local side. There we go. So another key difference between the House and Senate bills was that the House bill repeals the tax exemption for private activity bonds. The Senate bill maintains this exemption, but 20 House Republicans signed a letter calling for the tax exemption to be maintained. I think what we end up seeing here is there'll probably be some special language that doesn't allow private activity bonds to be used for sports stadiums, and there might be some other restrictions in there, but ultimately the tax exemption will remain in some form. If we go to the next slide, another key municipal bond provision affects advanced refundable municipal bonds. So section 3602 of the House bill leaves interest on advanced refunding taxable effective in 2018. The Senate bill contains the same provision. So there's been some issue here, but I think this will actually make the final bill because it raises $17.3 billion in revenue. So it's not likely to be taken out or be fixed in the meantime, although there is some support from Senator Boozman to allow advanced refunding. Go to the next slide. Another key difference between the 2 bills I had mentioned earlier is that the Senate threw in the alternative minimum tax at the last minute. So that, in addition to the corporate alternative minimum tax, they also had put back in the individual alternative minimum tax, but put a higher cap in that. So the House has kind of this is drawn a lot of kind of outrage in the business community because it basically throws away all the deductions that most corporations would now be forced to take the corporate AMT rather than use deductions. So that's something I would think the House would take out in the final bill. So those are kind of the key differences between the 2 and some of the obstacles they have to face. Are there any questions there, or do we want to move on into it?
Yeah. So, hey, Rob, thanks so much. And for the folks listening in, as you put together your thoughts and questions about, the process in which tax reform occurs, Rob has a very inside view of what's happening on the political scene. So I received a lot of questions about funding the government, and feel free to keep loading them up. And we'll definitely we'll get to them after we hear George's presentation. So Rob, thanks so much. We'll switch over to George here. George, I know you have a lot of thoughts, and you probably have some questions for Rob as well. We'll turn it over to you and to help us think about the way that tax reform is really going to impact our market going forward. And we're already seeing it with this week with 20+ billion in new issues scheduled to price or have already priced. Thanks, George.
Mm-hmm. All right. The couple of opening thoughts and considerations. One, just about what happened here. I've been involved in the battle to preserve the tax exemption literally since 1985, pre-Reagan tax reform, and it's never gone away completely. And we kept making the policy case why munis and things like deductibility and new market tax credit and all the things that the benefits in the tax code for that help state and local governments, we've been making the policy case why those should be continued. And frankly, in the last go around here, the policy case stopped mattering. All the good arguments we had made basically got ignored for one very simple reason. They had a plug number that they needed to reach to keep the cost under 1.5 trillion. And they went through the list of tax expenditures and got an estimate of what they would cost, what they would benefit the revenue side by eliminating these tax expenditures. And relatively high on that list were deductibility of state and local taxes, refunding of municipal bonds, and private activity bonds. So all the policy cases in the world meant less than the need for those plug numbers. And I would continue to make the case, and I'll talk about why that might matter at some point, that the plug numbers they're using on the cost of the tax exemption are continue to be vastly overstated. I don't know, for example, how you get 17 billion out of eliminating advanced refundings when most advanced refundings are under 2 years. 70% are under 2 years. And
10 years.
Tax rate is also going down. For corporate tax rate is going down so much that means less revenues from avoiding that tax than would have been the case under the prior tax code. So I do not believe that those concepts were ever reconciled, although getting a hold of methodology on the fly is almost impossible in terms of what joint tax actually did. But their old methodologies were always wrong. I have no reason to believe that they were any better this time, but they are what they are. We never got to make that case. As far as where we go from here, as was noted by Rob, there are some substantial differences between the two bills. Things like corporate AMT, if it were to stay in, would make whatever private activity bonds are permitted even more problematic, because most, other than healthcare, most private activity bonds are subject to the AMT. But as Rob noted, there's a very, very good chance that the corporate AMT will either be eliminated or at least taken down to a substantially lower number in terms of tax rate than the 20% on the corporate side. There was also a statement from Ways and Means Chairman Brady that private activity bonds had gotten away from their original purpose in that they were very local in scope, rather than the project that need to be national in scope to qualify as private activity bonds. That's simply not the case. The idea behind the municipal bond market all along has been local control of local projects targeted for the priorities of specific state and local governments. And there has been no transition away from that process, nor has there been any increase in the amount of these bonds issued. Issuance peaked in in 08 and again in 10 when there were BABs. issuance has been sharply lower in all bonds, but also in private activity bonds. New money issuance has been sharply lower ever since, has not bounced back sharply. So the idea that somehow we've gotten away from our original intent is not correct, nor is the idea that the market has been flooded with this kind of paper. It just never happened. But again, those policy issues didn't matter all that much when they were looking for plug numbers, which is what they were looking for. I wrote a piece that came out on Wednesday, a special focus that, that one of the things that is being damaged here badly is the whole concept of fiscal federalism, where there are federal, state, and local partners in the process of funding key infrastructure and related projects. And ironically, on exactly the same day as my piece was going to the press, Standard & Poor's wrote a series of comments around exactly the same concept, that the federal, state, local relationship is being impaired by what is going on in tax reform. Again, in terms of this process, that only matters to the extent that our relationships in Washington on the bond side, and I've been working with the Municipal Bonds for America Coalition on all this stuff for months and months now, but they have the contacts that matter through their government relationships at the federal level and also their issuer relationships. And they continue to press the case, particularly on private activity bonds, that they be reintroduced in conference. And we'll get some back. As Matt has indicated, we're going to lose stadiums. I can live without stadiums if we get the vast majority of private activity bonds back. And I just don't know, nobody knows how much of PABs we will recover. The policy case for keeping virtually all of them is a strong one, but again, we don't know how much policy matters. Our partners in Washington are pushing the policy case to a degree through Holmgren, who is our point person on the House side on these issues. And the House side is where the issues are on PABs, because the Senate bill does not do anything to PABs with the possible exception of stadium paper. The other part of the bill that we are going to lose, unfortunately, I am confident, and wish I were not, we're going to lose tax-exempt advance refundings for now. And I suggest for now, simply because there is a potential fix floating around. I won't attribute to any one source, but the idea of permitting advance refundings where the escrow is invested in tax-exempt bonds rather than treasuries is being discussed. I would be very surprised if it makes it to this bill, but I'm also fairly confident that there are going to be some fixes later on. And I think that provision, where we get back access to doing refundings at a somewhat higher cost because of the use of munis in escrow rather than treasuries in escrow, I think there's a real possibility that we get back to that in what I consider rounds 2 and 3 of this process. And I'll talk about why I suggest more than one round as we get to it. There's also the whole issue of infrastructure. There are, even as we speak, there was a discussion in, I guess, the Bond Buyer yesterday about, or one of the major financial papers, about what an infrastructure bill might look like in the aftermath of this. I don't believe there will be an infrastructure bill anytime soon. when you're starting with $1.5 trillion deficit, that by dynamic scoring gets all the way down to $1 trillion. It's still $1 trillion over 10 years. I am confident that the House side in subsequent negotiations on other legislation is going to be extraordinarily resistant to anything that has a significant net cost associated with it, and any infrastructure bill that's worth anything in terms of helping funding and financing of state and local issues will have a cost. The numbers that are being floated around is about 200 billion, but I don't believe we get an infrastructure bill. Again, the chances for federal infrastructure support through subsequent legislation, for now, I think are pretty tiny. In my piece on Wednesday, I listed about 10 of the ways in which this is a tax hike for state and local governments. It is, the laundry list of ways in which this makes state and local governments' costs go up is substantial. There's the pressure created by elimination of deductibility, except for the $10 million cap. However that looks, it's less than many states had available before, and will put downward pressure on tax rates in things like voted, elected, school district ad valorem tax rates. There will be pressure to keep it lower because of the limits on deductibility. In terms of state income tax rates, there will be pressure to keep them lower because of elimination of deductibility, which is at this point going to be more stringent than the or total relative to the cap procedure they're using on the state on the property tax side, and all the other ways in which the tax bill beggars state and local governments. The couple of other ways that are not related to munis, like new markets tax credits and the like. The simple fact that not being done to munis, but it's a reality that if you take the corporate tax rate all the way down to 20% from 35%, and then on top of that add some new provisions that are kind of hidden in the House bill, and I don't know what's going to happen to them, that make property and casualty insurance company and life insurance company holdings of municipals even more problematic through a new haircut that's, again, in the House bill. I don't know if it makes it to the Senate bill or conference. But the fact remains that the maximum tax rate on corporations is going sharply lower. There's been some rumors around, and I'll ask Rob for comment on that when I finish, that the corporate tax rate might go slightly higher to pay for the elimination of the corporate AMT, which the number being floated around that how much it would cost is about $300 billion over 10 years to eliminate that, which is why it was put back in on the Senate side to begin with. They needed the revenue in terms of the way they were looking at it. So there's rumors around that we might get a slightly higher corporate tax rate. I'm not holding my breath for that. And if we had to whatever corporate rate we have being very sharply lower will mean that the demand curve from corporations, meaning mostly banks and to a very much lesser degree insurance companies, that demand curve is going to shift lower. It's going to put more pressure on individual investors to fund to be the buyers of last resort of municipal bonds, which will create a radical shift in the structure of the muni market that I'm not going to get into here. But I believe that with substantially less demand from banks, with negligible to negative demand from the insurance side, that individual investors are going to have to pick up a significantly larger part of the demand side of the muni market, which may be a significantly smaller market, no doubt, depending on what happens to private activity bonds. In terms of the size of the market, the last point on this slide, I expect that over time, this bill will push interest rates somewhat higher, all interest rates, not just munis. It's going to increase the size of the federal deficit, which means more federal borrowing. To the extent that it stimulates, that wouldn't matter if that stimulus were to be invested back into new corporate projects. Most economists I've talked to don't believe that that's going to happen. And if it doesn't happen, then you just get more extra money floating around, some of which would end up causing somewhat more inflation, although I'm certainly not an inflation hawk. But somewhat higher interest rates in total, certainly somewhat higher interest rates, at least on state and local government projects, with the biggest impairment in terms of higher interest rates on municipal bonds being for smaller issuers. For example, those that use direct placement with banks, there will be far less direct placement with banks than there was. There will be more challenges in underwriting during periods of heavy supply with less demand from banks. And the whole structure of demand.
Can I interrupt you for one moment? Because I'm getting a couple of questions about this. With a higher interest rate environment, do you see the public-private partnership world that has always been, obviously it's very strong in Australia and Europe, and has been circulating the United States. Do you see more P3s in our future as a result of this bill?
Interesting question. I'd say only slightly. The problem is, it depends. If we keep a significant portion of private activity bonds as tax exempt, then the question is under what rules that's the case, and then whether we can do those in conjunction with private partners. Otherwise, yes, some projects spill over to the fully taxable side, but their cost will be substantially higher. And unless there is some subsidy from the federal government, a la an infrastructure bill, we're talking about total all-in costs that would be substantially higher and would be an impediment to getting these projects done. Now, I'm a bull on public-private partnerships for one simple reason. I think technological change, which has been kind of my hobby for the last 4 years, makes a case for more direct involvement in projects, state local projects generally, right from the get-go. What's called design build instead of design bid build, and that means engineering partners, funding partners, architectural partners, technological partners. I think the case for moving towards that is spectacular. Our only hope is that tax reform doesn't impair it by pushing the muni partner out of the tax exempt market. But yes, we're going to see more partnerships no matter what comes out of this bill because of technological change and what it means for the relationship between issuers and their partners.
Yeah, thank you. And hey, George, this one other one as we're on this point. This was say anonymous attendee asked regarding the private activity bond point. Does it look like tax exemption will likely be preserved for healthcare issuers, airports, and affordable housing, which clearly is that's a $30 to $40 billion a year market. I'd like to get your thoughts on that. And then Rob, if you have any thoughts on just like some of the political aspects of that, I think that would be really helpful.
Yeah. Right now, and I think Rob kind of alluded to this, and I'll pass it back to him. It kind of looks like we may get to keep most of the private activity bond market. The Senate didn't include any elimination. The pressures on the House side to give state and local governments a break here are pretty dramatic. So we may get to keep most of it, which would mean keeping healthcare and airports and ports and solid waste disposal and development and multifamily housing and the like. I think there's a real shot at that. Rob, if you agree or disagree, love to hear it.
Yeah, I agree. I think, like you said, no one's going to miss sports stadiums, but I think Republicans are under pressure not to pass anything that could be construed as mean. And I think if you're eliminating the tax deduction for especially affordable housing and healthcare, I think that's something where the optics would look so bad that they'd have to make some fix. So I think what ultimately happens is they do sports stadiums and then maybe some other kind of restrictions, so they can say they kept PABs on their original intended mission.
Yeah. So, what we do lose is, there are times where refundings, particularly in the healthcare sector, are important. For example, if you have a hospital that's close to bankruptcy and you want to merge it with a healthcare group, often there are bonds that need to be taken out. Well, those will have to be taken out at this point through taxable refundings. And maybe later on we get back the fix that I suggested, where you can do true advance refundings if the escrow is in tax exempts. That's a zero cost solution, by the way, because if you're using munis in the escrow, then you're eliminating as many munis during the escrow period as you're adding, and there's no cost to the federal government. So I think we have a real shot at that.
I would agree. I think the only thing I'd add is that I think we'll be seeing a lot of fixes kind of similar to that. Anytime you have a bill this large moving on a deadline, you're going to see, have some kind of unintended consequences that have to get fixed down the road. So I think certainly advanced refundings and probably some of the international provisions will be tweaked for years to come.
Yeah. That was going to be my next point. This isn't over when it's over. I feel I'm highly expecting, good news or bad news, that there will be fixes absolutely necessary. You can't do a tax bill this fast and not have loopholes you didn't expect, damages you didn't expect, language you didn't necessarily get exactly right. So there will be tweaks later on. This is tax reform 1. There will be tax reform 1A and 1B that are vastly smaller bills, in which things like zero cost refundings, I think, have a really fabulous chance of being considered. The bad news is, if they need revenue during the fix, it's not necessarily the case that we don't lose some things again. So one of my main messages here is this thing isn't over when they sign the bill, and we all need to be attentive to what potential additional fixes might look like, where there's a window of opportunity, like in refundings, where they need more revenue, which they might, in order to fix something, the way they're needing more revenues to fix the AMT. So this isn't over when it's over. In this case, Yogi Berra was incorrect.
Hey, George. Yeah. We're at 9:45 Pacific time. I'm in San Francisco.
Yeah. Right, let me just,
there's a few questions that I want to get to, which I think are great.
Yeah. Let me just wrap right up. The muni market has rallied spectacularly the last 2 or 3 weeks, because instead of focusing on the fact that we had a glut, and we'll have about, I think, 70 billion this month, including a lot of deals done right at the last minute that get closed and then resold later on. But the market has handled the supply for now. down like 40 basis points from the peak in yields around 3 weeks ago. So that problem has gone away. The next challenge is going to be whatever we can do to get fixes in subsequent discussions, which I expect they will be. And with that, I'm finished.
George, you caught me off guard there. So we have a few questions. I mean, the first one actually is for you, George, and also Rob, and I don't know if you want to weigh in on this, but today the Treasury Department has suspended the state and local government securities, or slugs. What is this? How does this impact issuers going forward? Looking at refundings for the next couple of weeks. I mean, does that impact our crew here?
Yeah, I think most refundings get done anyway. You know, it's important to note that the reason for creation was slugs was to burn arbitrage, not simply because they were needed for an escrow. It was because they were needed for an escrow to bring the yield down to where it needed to be, so that you didn't have positive arbitrage on the deal. What's going to happen during this period is that underwriters are going to have to scramble in the Treasury secondary market to find matching bonds, and that's going to be harder. And it could mean that some refundings don't get done, but that's a question of supply demand. It's not a question of the legalities surrounding whether you use slugs or not.
Okay. We're looking at a week with $20+ billion of issuance. And we were talking earlier, George, about potentially $60 billion month. It leads me to believe that there is the large thought amongst the market, issuer community, that a lot of these rules are going to be retroactive. And by that I mean, if you have issued a private activity bond or an advanced refundings, that they will be now taxable outstanding. Mm. What are your thoughts on that? And Rob, obviously,
my understanding is they're almost all moving forward. I haven't seen many measures that are retroactive.
But Rob, doesn't the score on this doesn't really make sense if you only going forward, right?
No, it doesn't change the score much, Matt. It's December 30th. December 31st is the effective date. That's been the effective date all along. It was included in the scoring. And while the issuer community is looking for some relief on, just making sure that all deals qualify if certain steps are taken by the 31st, I don't think anything changes there. It's what was in the original bill on the House side in terms of effective dates. And the reason, by the way, that there's such a rush to market is because we don't know if we keep PABs. So PABs issuers are scrambling hard to get their deals done in addition to refundings, so that we're at risk of losing refundings. We're less at risk of losing PABs, but we don't know which ones. So any issuer, especially now that the market has rallied like crazy, any issuer in the PAB market who doesn't know if they're going to be saved or not, they're going to come right now.
Yeah, no, it's a very interesting, I think it was 2012 that based off of a New York Times report on stadium bonds taking advantage of the private activity provision, they had a whole committee hearing on that issue. And I want to get back to this one question I think really resonates with me is, private activity bonds, yes, maybe they have been utilized for very private purposes that most people don't think has a social utility, but they're also very involved with healthcare, airports, and affordable housing, which is extremely important. And so I hope, George, with your work with the Municipal Bonds for America, and Rob, with your work with the Bond Dealers of America, which sponsors a lot of their work, is this something, are you distinguishing this with policymakers as we get very close to enaction of legislation?
Sure. We're essentially the community has recognized that they have to throw stadiums overboard, although they'll never, many won't admit that. But other than that, the community has, the case is that 95% plus of PABs are involved with a public purpose in some fashion or another. And that case is being pushed hard in those that have access to the conference.
Rob, have you had any discussions about distinguishing what a private activity bond is and what should and should not be eligible?
No, I mean, obviously sports stadiums, as we mentioned, are the easy case. After that, it's a little less clear.
Golf too.
Yeah, golf courses will probably be maybe a casualty there. But anything, I think healthcare, airports, and affordable housing are kind of clear public purposes that will be ultimately still have this benefit available.
Yeah, and development and small issue industrial. Again, as long as you can draw a straight nexus over to the public purpose, I think we have a real shot at keeping them.
So we have a handful of issuers on this call right now that I'm assuming are thinking about current interest rate environment and the load of issuers that are coming to market over the next few weeks. If you were an issuer, George, what would you do? What is your approach? Would you come to market now to get ahead of the tax uncertainty, or would you sit back and let a lot of these sort of things fall out and then figure out your debt profile?
I come now for a reason that might not be that obvious, and that's the spectacular rally that we've had. I come now if the machinations of getting your deal done with a closing date of December 31st aren't too onerous. And the reason why is I think that, what we call the January effect in the muni market, which always happens in December, has already occurred. That relates to the fact that there are massive amounts of bonds being called or maturing December 1, January 1, February 1. That's already in the market. The market is already also taking into account that there will be fewer bonds at some point going forward. What I think the market may not be fully taking into account is that there's going to be a vigorous market of secondary offerings once we get through December 31st. And I'm not confident that rates go any lower after the spectacular rally that we've already gotten through here. So if the difficulties in meeting the 31st effective date aren't too onerous, I think this is a good time to issue.
So, and what do you think, this is a question that came in, what do you think the impact on healthcare consolidation will be on private activity bonds? We've seen a lot of refundings, issuance as a result of large healthcare networks consolidating through private activity bond issuance. Do we see, and then obviously on top of that is Obamacare potentially, being reformed? Does that have an impact on issuance levels and how those entities can access the market?
Well, the refunding provision, if we don't get at least the fix that I suggested, would mean that all refundings in anticipation of merger would have to be done taxable to the first call date. And then you might be able to refinance at the first call date with tax exempt bonds in some cases. But, getting those mergers done is going to become more costly as a result of what the bill looks like, assuming we don't get this zero cost fix later on. If we get the zero cost fix later on, then those kind of refundings will still be more costly than under current law, because let's face it, using muni escrows is not as attractive to the investor as using tax exempt treasury escrows. But the deals will still, in many cases, have to get done where in cases where you have an issuer in crisis, or where where simply the cost of doing business drops sharply when you're part of an obligated group, as opposed to, for example, a rural hospital on its own. So I think a lot of these activities continue, but they become more costly.
No, thank you, George. That's great. I believe we've answered all of our questions, and we're running up against our time. I just want to thank, George, Rob, you guys. This has been very insightful about the future. And I just, for all our market participants, I wish we have several handfuls that are part of this discussion. Thank you so much for participating. And if you have follow-up questions, there is an email on this slide here, issuers@neighborly.com, that you can ask us about kind of what we're seeing. We're working with George, we're working with Rob, very engaged in what's happening in Washington as it pertains to the future of our market. So with that, I just want to say thank you so much, George Friedlander, Rob Wanger, and the silent partner here is Garrett Brinker, who's done some great stuff here to make this possible. So everyone have a wonderful, wonderful holiday. Thank you so much.